Hey, what's going on? It's Nick here from Ways of Wealth. Thank you for tuning in. Week 30 of the market recap. If this is your first time here, we highlight key events that happened in the market over the past week. So I'd like to ask you a huge favor. If you've learned something new, please give me a thumbs up. It definitely helps the channel grow. If this is your first time here and you haven't subscribed already, please click that subscribe button. We do this every single week. We have an awesome episode lined up for you this week. We're going to be talking about SPACs. Now, if you haven't heard of this investment vehicle, it's kind of like the IPO 2.0. So stay tuned. We'll break it down. We'll talk about all the recent ones and we'll learn about the advantages. All right, let's dive in. What is with all the hype behind SPACs? It seems like every time I open up a new browser or I flip on the news channel, I see that there is a new SPAC that is being formed, that is being acquired, merged. What is it? I thought I would take this episode to break down what a SPAC is, kind of some examples of what's going on, and some of the advantages and views and beliefs on the market right now. And we'll start off with the acronym. What does a SPAC stand for? It's a special purpose acquisition company. Okay, and what does it do? So it's basically a blank check company. It's a company that lists on a stock market, so it's publicly traded, with the intention that it's going to tell its investors that one day it will acquire another company. So you are investing in the company in the early stages, knowing that there is no operations, there's no revenue, there's nothing other than an executive team that is perusing the market, trying to find a company to buy, to acquire, to merge with, and then rechange the symbol and rechange the company and avoid that IPO, the traditional way where a company goes to investment banks and then from there they IPO. So it's kind of what I mentioned before, the IPO 2.0. Now this investment vehicle is nothing new. They were originally created back in the 90s, but after a couple bad performances, they've kind of got the rap as being a bad investment up until recently where the tide has changed and it's become the new way to get your company to market. Not only have we seen a massive increase in the number of SPACs per year, but also in the billions of dollars that these companies have garnished. Even more recently, there was $3.2 billion raised in 2016 with a total of 13 IPOs, whereas last year finished off with 59 IPOs, amassing $12.1 billion. That is a 278% increase in funds raised and a 353% increase in IPOs over that 3-year period, and the trend looks to continue for 2020. This week, Chamath Palihapitiyas, who is the CEO of Social Capital and was a former exec at Facebook, was on Squawk Box and he was asked his opinion on SPACs. And I think he did a great job of formulating why these positions or investment vehicles are beneficial to the investor. So I will let you hear his words directly.
Chamath, I want to pivot the conversation for a moment to SPACs. You've launched now several, and I know there's a couple on the way here as well. You've talked about them in the context of an IPO 2.0. How much of this, though, is an indictment of the IPO model? But at the same time, what does it say about transparency? Because there's a lot less in the SPAC model than there is in the IPO model.
I actually think it's the exact opposite, and I'm glad you asked this question. Let's just talk about transparency for a second. When you go through a SPAC, what you, the CEO and the company, are allowed to do is actually take your time. You're allowed to take as many months or as many weeks, or frankly longer if you want to educate the buy side, to educate investors, both retail and institutional, about your business. You're allowed to create a multi-year forecast for the business. You're allowed to sit there and walk them through all of the assumptions, do all of the stress testing with them, and essentially, instead of speaking at them what happens is you have a conversation. And in that conversation is meaningfully more transparency. And you saw that play out firsthand with Virgin Galactic. It was one of the key things that I tried to do is basically demonstrate the value of transparency. And transparency is critical. And Aaron, the reality is that we are now moving away, Andrew, from a very, very different model. For example, the rules now on 13Fs are going to move where large hedge funds only have to publish what they own. And all of a sudden, when you lift the bar, that's not more transparency, that's less, right? In fact, what we should do is actually force every single hedge fund to publish not just their longs, but also their shorts. And that would create meaningful more amounts of transparency and allow us to understand why are certain investors piling into certain companies or shorting others? Are they trying to manipulate? Is this about momentum? Or is this about some fundamental idea that we should all understand as well? So the rules are actually moving away from transparency, which is why things like SPACs are valuable. In terms of the traditional IPO model, let's be clear. The banks serve their customers and they do a great job. It's just that in the IPO, the customer is not the company going public. The customer are the hedge funds, folks like me, that pay them tens or hundreds of millions of dollars in fees so that I can use them for trading, so that I can use them for leverage, so that I can use them for a whole host of things, which they do incredibly well. And then they reward me with cheap stock. And look, I'll gladly take it. But the reality is what I'm telling you and what I'm telling our viewers and what I would tell all retail and institutional investors is that that game has to end. And we need to level the playing field. We need to allow companies, more of them, to go public faster. Let's get that 4,000 closer to 8,000. And we need to allow them to talk about what they're doing in a way where there's actually more transparency, not less. You'll have fewer of these, mind-blowing Tesla examples in terms of the frustration. You'll have more investor support, and Elon and folks like him won't have to fight and push sand uphill. In fact, what it'll be is just a broad base of support that makes good companies win.
I think the point that Chamath is trying to make is highlighting and hitting the head on the transparency factor. With the IPO process, there can be a little bit of a gray area when it comes to the investment banking, and the process involved, you have to have this company that's trying to grow, but then the executive staff is traveling around investment bank to investment bank trying to pitch. And depending on how that pitch goes, it depends on what that IPO price is going to set at. Now, with an open and honest communication between the SPAC and the company, you can be clear about what the vision of the company is, where the company plans to be, what's your 1 year, your 3 year, your 5 year plan. And we actually saw Chamath with one of the bigger SPACs last year, where he partnered up with Sir Richard Branson, and I'm not sure if you're familiar with him, but very big business mogul under the Virgin brand, Virgin Records, Virgin Airlines, so many different platforms, but they actually brought Virgin Galactic to the market last year. Now this company trades on the market as SPCE is the ticker symbol. And if you purchase space on its merger date of October 28, 2019, you would be up 106% as of close this past Friday on July 24th, 2020. The stock did effectively gain quite a bit of attention, climbing all the way up to $37.35 per share towards the end of February, but it did pull back during the market crash in March, but it's still not too shabby of a return. Let's take a look at some of the other recent popular SPACs. First off, let's take a look at DraftKings, the popular online sports gambling site, which allows users to put their money where their mouth is when it comes to wagering on their favorite sports team. As more and more states legalize gambling on sports, combined with the return of sports, this should help increase revenues over the short run, but the long run prospects do look enticing on this one. If you invested on April 23rd, 2020, when the ticker changed to its new symbol, DKNG, or what I like to call Donkey Kong, you would be up close to 119%. Seems like there's an ongoing trend between the gains of over 100% on these things. Billionaire investor, hedge fund manager Bill Ackman recently made headlines this week with his SPAC, Pershing Square Tontine Holdings, as he has committed over $1 billion from his hedge fund and is looking to seek $3 billion from investors. This makes this the largest blank check investment vehicle in history. Ackman is looking to sell 150 million units at $20 a pop. But it is not all sunshine and lollipops when dealing with these SPAC investments. You can't just put your money in and to expect 100% gain within only a matter of months. The next example we will break down is where there are risks involved in dealing with a company that has a lot of hype and momentum behind it. And that company is Nikola Motors. And this is an electric vehicle company which emerged with Vecto IQ acquisition, and that ticker symbol before was VTIQ, and it premiered on the stock exchange on June 3rd this year as Nikola, and it opened at $33.69. So NKLA opening on June the 3rd at $33.69. Only 6 days later, okay, this stock price was $93.13. That is 176% gain in only a matter of 6 days. Now, if you still hold that share, you would be down 11% today. So that just shows you about the speculation, the momentum, the hype that was built into this company. And then when, proof is in the pudding, you see that this company currently does not even have a prototype of the electric car, and it was getting valuations and market caps that had equaled a company like Nissan that had been around the block for many of years. So that just shows you that these companies are speculative in nature still. Now this brings me on to my quick thoughts about what I think about SPACs. And although, it could be a potential for a quick return or a quick buck, it's not, for me, it's not my personal style. I like to look at a company with at least 5 years worth of financial data, if not 10. So a well-established company, and then from there I can, better forecast. With a brand new company, it's hard for me to determine what the true value or what the true stock price should be, or at least in a range. And we all know that currently in this phase of the stock market, the valuations completely mean less than ever before, and everything is moving on momentum. So maybe I will miss out on some gains in the short run, but I believe my strategy will work for the long run, or at least I hope so. And that is all for this week in the market recap. Again, I appreciate your support. If you haven't already, if you learned something new, please smash that like button. It helps the channel grow. And if you're not already subscribed, I'd ask you a huge favor. If you made it this far, we do this every single week, providing you quality content. Please hit that subscribe button below. Turn the notification bell on. I also have Instagram. I will throw that up here. Let me know what you think down in the comments. And that's all I'm gonna ask you for. Have a great week on the markets. Happy trading.